Good day, I'm Rupert Giessing, Business Development Manager with Equilibrium Investment Management. With quarterly statements going out soon, we wanted to give you a quick update and overview regarding markets and the performance of our multi-asset house view solutions, which includes the MFP Focus model portfolios and the Momentum Focus fund of funds. September 2022 was no exception to the September effect, which refers to the historically weak stock market returns observed during the month of September. In fact, September has been the worst performing month on average going back nearly a century. Global equity markets suffered substantial losses during the month. The monthly drop in the S&P 500 index was the worst since March 2020, and the 4.9% decline in the third quarter followed losses in both the first and second quarter of the year. The last time the S&P 500 index experienced 3 consecutive quarterly declines was during the global financial crisis between mid-2007 and early 2009. With central banks worldwide adopting an aggressive approach to monetary policy to rein in soaring inflation, the sharp tightening in global financial conditions has triggered concerns over the health of the global economy. The Bloomberg median consensus expectation for a recession in the United States in 1 year's time has climbed from 15% at the start of the year to 50% at the end of the third quarter. The probability for a recession in the UK has gone from 15% to 60% over this time frame, while the risk for a recession in Germany ranks the highest at 77.5%, up from 17.5% at the start of the year. For risky assets like equities, it does matter where the global economy experiences a recession or not. History has shown that equity drawdowns were much bigger and of longer duration in recessions than in non-recessionary slowdowns. In summary, it is most probably going to get worse before it's going to get better. During times of uncertainty, the defensiveness of safe haven assets like US bonds and cash becomes more attractive. Global property fundamentals remain solid, however, but the yields are currently expensive versus investment-grade bonds, capping the return potential for the asset class. Locally, due to their cheap and absolute relative valuations, South African equities could either hold up relatively better during global equity drawdowns or at least provide better returns during subsequent recovery phases. South African real bond yields are attractive versus global yields and are also higher than their historical average. The prospective SA real cash yield has been rising from a low level in line with policy rate increases and is now only slightly below historical averages, whilst the potential for meaningful South African listed property return upside from undervalued levels needs to be weighed against some remaining negative fundamental factors. During periods of increased market volatility, it can be easy for our recency biases to get the better of us, but we have to remain aware of the long-term return potential for all asset classes, and that our multi-asset solutions are already positioned to capitalize on these returns. Here with a quick overview of the returns of all asset classes as at 30 September. We can clearly see that there is a big difference between short-term returns over 1 month and year to date, for example, and returns over the longer time horizons, especially so for the more volatile asset classes like equities. But that is also where the real growth potential lies in the long term. In constructing our multi-asset solutions, we are well aware of the significant potential for short-term volatility in some asset classes. This is incorporated in our portfolio construction process and directly related to the minimum recommended time horizon of the specific solution. If an investor's objectives did not change, there is no need to make changes to their investment portfolios during times of excess market volatility. In fact, market volatility often creates significant mispricings and buying opportunities for portfolio managers, which means that when markets start to recover, and they always do, investors will be ideally positioned to participate in the market recovery, but only if they stay invested. More often than not, one will not time the market correctly and lock in losses when switching to the perceived safety of cash during uncertain times. I would like to also remind you of the following slides that Dean shared at Outcome Matters, comparing the outcome of staying invested versus switching to cash during the perceived previous bear market that was only just 2 years ago. The comparison was done from January 2020 to June 2022, looking at investment in the Momentum Enhanced Yield Fund versus the Momentum Focus 7 Fund of Funds. It is very important to remember that the purpose of this comparison is not to show that one solution is better than the other, but to illustrate where one would have been if they remained invested, irrespective of short-term market volatility. The first chart compares the outcomes of staying invested in the same portfolios throughout the crash of 2020 up to June 2022. The total return would have been 16% for the Focus 7 fund and 15% for the Enhanced Yield fund. The second graph shows the results if an investor started in the Momentum Focus 7 fund of funds on 1 January 2020 but de-risked and moved to the Momentum Enhanced Yield fund on 31 March 2020 because of short-term fears. After more than 2 years, the investor would still not have recouped the losses incurred in early 2020 and would have been down 10% on their initial investment. In the third example, we assume that the same investor re-risked and moved back to the Momentum Focus 7 fund of fund at the beginning of 2022, given the strong returns from equity markets in 2021. This is a classic example of trying to time the market and shows that the investor would have been down 18% on their initial investment by switching back. This is a total return difference of 34% to the investor that stayed invested. To put it differently, that is 54% value destroyed simply because an investor overreacted to short-term market movements and switched out. In line with expectations, all the multi-asset solutions have had subdued returns over the past quarter, with the longer time horizon portfolios being impacted more. Even though these returns, especially in the more aggressive portfolios, have been disappointing, the funds have done very well to cushion investors from market volatility due to their well-diversified nature. Returns over a rolling 12-month period are also still well within the internally defined risk measures that we have in place for these solutions. Please remember that returns longer than 12 months for the MFP Focus model portfolios are simulated returns. The numbers have also not been finalized yet due to time constraints, so there can be a slight difference to the official numbers that will be published on the September 2022 fact sheets.